Is all logging big gains for the day, for the week, largely thanks to Wednesday's historic rally after the tariff pause enacted by President Trump on that day. But joining me now is Unlimited Funds CEO and CIO Bob Elliott and Ariel Investments Vice Chairman Charlie Bobrinskoy, along with CNBC's Leslie Picker, watching the moves that we saw today for the banks. It's great to have you all here. Bob, I'm going to start with you because there's been a lot of focus on technicals here in this market. Is this an S&P that is trying to find a bottom here? And if it is, do you buy the dips?
Yeah, I think the market right now is getting a little bit of relief on the hope that this set of tariff policies are going to eventually and quickly be reversed. If you look at surveys of investors right now, the expectation, 80% of them expect this tariff policies to be wiped clean within the next 3 months. And I'd say that is a pretty aggressive expectation. It's a reason why the market is where it is today. If you expect any chance that these tariff policies are going to persist or there will be increasing conflict with the Chinese as a function of the extraordinary tariffs there, the S&P 500 at these levels is not at all close to pricing in the type of recessionary dynamic that will occur if these tariffs persist anywhere close to where they are now.
Okay. Charlie, want to get your thoughts on what we've seen, especially given the fact that so much of the action, so much of the volatility has not just been in stocks, despite massive intraday moves that we've seen for the major averages every single trading day this week, but in the bond market and also in the FX market. Can we say that bond vigilantes are back?
Oh, absolutely. We have grown up taking for granted that the risk-free rate is the U.S. borrowing rate by the U.S. government. And if that gets called into question, it changes everything. It changes the discount rate on bonds. It changes the discount rate on a regular mortgage. It changes the discount rate that the U.S. borrows at. We borrow about $30 trillion. That's trillion with a T. And it's all based on a certain understanding of who the U.S. government is, the fact that we're the most pro-business country in the world, the fact that we have rule of law and sanctity of contracts. If you start to change all that and say that we're going to be unpredictable, and all of a sudden the Japanese and the Chinese don't want to buy our $30 trillion, then everything changes, and that it doesn't change for the good. So this is a very important time. Frankly, I didn't sleep well Saturday and Sunday night thinking about the bond market, because if the bond market starts to have trouble and people stop buying our bonds, everything changes.
Yeah, I mean, I'm seeing the catchphrase out there right now, the sell America trade. Yeah, we did have investor Bill Ackman on X this morning, and he talked about what he thinks we're seeing in the market, and basically saying that investors are paying too much attention to short-term market movements in rates, currencies, and equities, and basically pointing to highly leveraged market participants, Bob, being forced out of positions. That's more of what we're seeing in terms of dislocations, what's triggering these dislocations rather than fundamentals. He says, quote unquote, as a result, markets have become increasingly unreliable as short-term indicators of the impact of policy changes. Do you see it the same way? We've been talking about margin calls and everything else.
Well, of course, anytime you have stress in the financial markets, there's going to be some levered folks who are going to be short squeezed and take some losses, and that's going to create some volatility in the markets. But the big picture story in terms of whether the markets are functioning, in a way that's sort of normal, maybe not what we've been used to the last couple of years, but normal in any longer term context, they're still functioning totally normally. And I think the real question that people are having right now is, how big a deal are we going to see? Is this policy mix, this tight policy mix, going to persist? Is it going to persist for a long time or a short time? If it's going to persist for a short time, then essentially growth is totally mispriced. It should be stronger. If it's going to persist for a long time, then it moves back the other direction. And things like bonds actually look like a pretty good deal at these levels.